At the ground, yes, Mahalakshmi. You can see the way, if you go around in the physical thing, there things have changed and things have definitely turned around. You see a lot of construction happening, RERA, etc., all having their, positive benefits and playouts that are happening. So definitely it is. But I find that real estate stocks tend to be a little more complicated because, that business is not as simple or as kosher, so to say, because at the ground reality, that this is one area where still the number one and number two cash element is highest in any industry. So I think that creates a little bit of opaqueness about the business. As I said, the stocks are doing well, they will do well, ground reality is very good. But my comfort comes a little slow because ultimately I need a clean business. We need clean managements, we need good business practices, because only then do things translate into the bottom line on a genuine and on-merit basis. Very often when that number can be changed very easily, it leaves a lot to be desired. As I said, there's a lot happening. The sector is doing great, yes, but if it suits a certain investor style good, probably doesn't suit my style at the moment.
The momentum is clearly on the side of the small caps. I want to give a caveat. The small caps are volatile. They're very dangerous. That's not for the faint-hearted. Don't go and put all your money into 2 or 3 stocks and then cry over Twitter that I got ruined. Please don't do that. That's not wise. That is pure gambling. But with all the caveats in place, the tape on small caps is extremely strong, and I do believe that it will continue to remain strong.
Whomever wants to participate, it has already built the exposure, so you will not be able to make much money out of that, despite we remain very constructive on the capital goods stock from a longer term perspective. But I think you have to look for unique ideas, and within that also sometimes stock correct for whatever reasons, okay? And if you like that sector, since we remain constructive on capital goods as a sector, if we sometimes get opportunity, we will do participate in it. But from the current level, slightly expensive, grossly overowned. So what you ask me, what you have to avoid? You have to avoid grossly overowned and most admired territory stocks. This cycle is all about under ownership and most neglected zone or hated stocks who have not performed for last 10 years or 1 or 2 decades also. Those are the names which will do better as compared to the stocks which were trading already in the most admired territories.
So Mahalakshmi, I've always struggled with the PSUs, I must admit, not just in India, but across the world. As you know, we have an emerging markets fund as well. And in other countries, the weight of PSUs in the market is much higher than in India. In fact, the emerging markets average is 20% compared to 10% in India, because there are several countries where PSUs make up 30-40% also of the index. But we've struggled historically to find attractive investment opportunities amongst PSUs. Valuation does on the surface look compelling. They have these companies anywhere in the world. PSUs would have higher dividend yield and low P multiples and whatnot. But the problem with PSUs in general, again, not talking in particular about India, but in general, problems about PSUs, alignment of interest is not there with shareholders. The government of the day in different countries may have different objectives that they want to achieve. Some of them in the name of social service or greater social cause, and those aren't necessarily the objectives of investors when investing in equity markets. And hence, from a governance perspective, we've always struggled to get comfortable with PSUs or SOEs as they're called around the world. We do own some, not just in India but across the world also, but they are fairly small portion of the portfolio for us. Some exceptional opportunities where we do own some, and that's also to considerable degree from a risk mitigation perspective. When it is such a large component of the market, you cannot completely avoid them.
Stay away only from fashion and only from trends. Ultimately, when you are investing in the listed space, you are investing as if you are becoming a partner in the business. And you'll become a partner in the business where there is at least a visible future profit trajectory. So, wherever you feel that there is a future profit trajectory which justifies what you're paying today, you're more than, I would say, encouraged to invest. You might go wrong in timing, and maybe 5-10% you might see a notional loss before you make money, but ultimately you'll end up making returns. But where you can't visibly see this, then it's a matter of time before your portfolio starts to bleed.